Now we have, companies reporting earnings that look robust and great, but they're not earnings from production. They're fake earnings by screwed up accounting that is being allowed now. And that investment gains are counted as income, even though they're not actually investment gains. So if you bought a bunch of internet and semiconductor stocks in the second quarter, and we look at what drove the market, you're looking at companies that are able to report huge earnings based on their investments, not based on the fact that they actually built more chips or sold more chips. Most people didn't sell that many more chips. They sold some. The demand's higher, but most of that gain came from double and tripling the prices, or at least their margins on what they were selling, like Micron and other companies. So they're able to, look like they're making tons of profits. They're spending more in growth trying to keep up, and they're borrowing more money in order to continue to meet the demand and expand their manufacturing capabilities and capacities. And they're also able to make purchases in other companies' stock, and that shows up as earnings. So it looks like the S&P is growing at 20 or 30% earnings growth. But when you look at the real numbers, the GDP doesn't support that, not even close. It's accounting games and cooking the books in the way that things are being reported. And I don't know if that can be sustained. So I think from the standpoint of looking at the GDP and how it affects seniors is let's go back and realize that the GDP at 1.5 does not support a robust stock market. The only thing that supports this robust stock market is gambling.